I want to discuss today the number one huge mistake that I see dividend investors making when it comes to selecting stock positions that they want to hold in their portfolios for the long run. So let's jump right into it. So in my last video, I'll link in the description below, I shared my number 5 stock pick of all time. This is a company called Clorox. They make these vitamins, Men's Energy, Rainbow Light vitamins. This Rainbow Light brand is really great. It's a funny story. In fact, I was boasting in the last video that I've been taking these vitamins and I haven't gotten sick. Man, I shouldn't have done that. As soon as I filmed that video, I came down with a fever and got really sick. Thankfully, I have recovered now more or less. I still feel a little tired. I don't know if I'm going to be able to do my workouts this week, but it was a quicker recovery than normal, so I credit that still with Rainbow Light, but I shouldn't jinx it next time. Anyways, awesome vitamins by Clorox. And then some of my subscribers are pointing out they also make Glad bags as well. So just another product that Clorox makes that I personally enjoy and use quite a bit. Anyways, I got some comments, and one of the comments said, Ian, I am disappointed that you chose Clorox as your number 5 stock pick of all time. The reason that I am unhappy or disappointed with that is it's just an expensive stock. The stock is not on sale right now. It's expensive. It's trended up quite a bit. Share price is doing well, and the starting dividend yield, the cash flow that one can receive off the bat from the starting yield, it's not very impressive at all. And so anyways, this comment really inspired me. It inspired me to film this video because I know that in my old days, when I first got started with investing, I used to think like this. And I know that a lot of investors out there, a lot of people, a lot of subscribers, because I see it in the comments section below. Thank you, by the way, for the thriving comments. Boy, I love this community here, 15,000 strong. I see it all the time. I see this kind of philosophy. And this video is all about why this philosophy is actually incorrect, at least for my strategy, for the way that I invest in dividend stocks. I shared my top 5 dividend stocks of all time here, number 1, and I'll link in the description below to separate videos about all of them. But number 1 is Johnson & Johnson, number 2 is Pepsi, number 3, McDonald's, number 4, United Technologies, and number 5, Clorox. And so anyways, I have covered these stocks. These are my favorite stocks of all time. And when I cover my favorite stocks of all time, a favorite stock has nothing to do with valuation. And so I actually jotted down some notes like I used to do in the old times. If you've been around on my YouTube channel from the early days, you will remember this. But I'm actually outside today in the Bay Area, 78 degrees in the middle of October. Doesn't get better than that. So I jotted down some notes, thought I'd head outside. But basically, the top 5 picks, these are my buy and hold forever stocks. Actually, all my stocks are that way, but these are the top 5 that really I'd be happy if I had nothing else, if I just had these top 5 forever. And so when I am picking my top 5, and I suggest when you are picking your top 5, the current share price should not be a factor. It shouldn't matter at all. If a stock is one of my favorites and it has a really high share price and I don't think it's a good value, like actually pretty much all 5 of these right now, I just won't buy them. I will wait for a buying opportunity. I will be patient. I will wait. And if one of them happens to be in the buy range, like Pepsi was earlier this year, for example, and I picked up some more shares of Pepsi, I will go for it. But the key here is it's important to pick a top 5. Everyone should have a top 5. And the reason for this is it helps the investor, the dividend investor, stay focused, not get caught up in the clutter, not buy stocks, keep adding positions that don't matter, but staying focused. And so that's important to have the top 5, but these top 5, they've got to be the best possible stocks that one can pick. The best stocks are not always going to be on sale. Quite frankly, a lot of the time they won't be on sale. And so if a factor for being a top 5 pick is, oh, it's a good value, that is not a good factor, at least for my personal investing philosophy. Now, I will tell you, it is different for different investing philosophies. If one is a deep value investors like to find an asset that is really underpriced. They like to buy it hold it until the price recovers and then sell. That's not me. That is a type of investor. Investors like that, some of them do really well, and it may make sense for investors like that to not look at things the way I am. But because I'm looking at stocks as buy and hold forever, literally, I'm talking 50 years, 100 years, I'm talking 200 years, I'm talking forever, I'm talking generationally. It all comes down to quality. It comes down to quality. And so, yes, it's really nice when I can buy a top 5 pick that's also a value, that's also on sale, and I try to do that. But quite frankly, when I'm just being philosophical and I'm picking my top 5, being a value alone cannot be a criteria. In fact, it's probably the least thing from my mind. When I'm picking my top 5, I'm literally picking the companies that I love the most, that I think have the best potential to reward myself and other dividend investors through cash flow over the long run. So another thing, I want to talk about some ranges. Johnson & Johnson right now, it's at $136, but earlier this year it was at $118. Whereas it might not be a wonderful buying opportunity, a wonderful value right now, it was earlier this year. Pepsi is at $107 right now. It was at $95.94 earlier this year. Again, Pepsi actually starting to get into value territory in my humble opinion, but it was even lower earlier this year. So again, this speaks to patience. The patient investor will pick, these are my top 5, and then the patient investor will wait and start buying when they become a little bit more attractive, or at least start averaging in, dollar cost averaging over time, so that one optimizes their opportunity to get into those lower points and not just buy it all towards the 52-week high. McDonald's, it's at $164 now. It was at $146 earlier this year. Quite frankly, McDonald's hasn't really been on sale this year at all. I have been buying a few shares just to add to it, just to average in, real small, but not a huge value this year. United Tech, it's at $132 now. It was at $115 earlier this year. Hasn't been a real buying opportunity all year, but one could say earlier this year, not a bad place to start. Clorox. This is the one I love the most for this example, because the subscriber said, Ian, I'm disappointed that this is your number 5 because it's not on sale right now. Not even long ago, just a few months ago, Clorox was at $113. Now it's at $148. Just goes to show that the fluctuations over a 52-week range can be dramatic. They can be so dramatic. And so the lesson here is, one, top 5 should have nothing to do with current value. It should be the top 5 that the dividend investor wants to buy and hold forever. Then the dividend investor should really exercise patience, because these opportunities come, and when they come, it's important to seize the opportunity, I'm actually proud of myself for buying some of the Pepsi earlier this year, sub $100. I am upset that it took me this long to identify Clorox as my number 5. I wish I had picked up some Clorox earlier this year in the $113 range. Oh well, it'll probably be back there at some point, so I look forward to that opportunity. So another takeaway here, and this is more difficult for a newer dividend investor. It gets easier when you're a seasoned dividend investor like myself. I have 38 stocks in my portfolio. I like to prioritize my stocks. That's why I've shared my top 5 recently, because those are the ones that I want to have the lion's share of my money in over time. Actually, it'll be more like the top 10, which I'm going to keep going down the list. But I like having 38 because it provides diversification. And moreover, by having 38, something is always on sale. And so this is what is a little bit more difficult when someone is getting started. But when one is more seasoned, like myself, it gets so easy, because even though my top 5 right now, none of them really are on sale. Maybe I'd say Pepsi is like a okay kind of value at this point. That said, out of my world, my universe of 38, I have stocks that are on sale right now for sure, and I am averaging into them. And in fact, I'll link to a video below that talks about some of the stocks I bought recently this year in 2018. So you'll see the types of stocks I'm averaging into over time. And certainly things have changed a little bit since that video, but you'll get a flavor of what's going on. So what is one to do, though, if they're just getting started? If one is just getting started, the way I look at it, at least, hypothetically, if I were starting over again, I like to prioritize. I wouldn't just go after value. I would still, maybe I'd pick up some value here and there, But for me, it's really about prioritizing, finding the stocks that I love. And then if none of them are on sale, I would either wait or I would just start averaging in. Most likely, I would start averaging in because I never know if a stock is going to keep going up, keep going down. It surely gets easier when I have a well-diversified portfolio like I do now because I just kind of wait and I look each month, hey, what's on sale? And then I look, is this stock already too big? If it is, I pass by. But if it's kind of small enough in the portfolio where I'm comfortable adding more, I'm like, yeah, easy, I'll just add to that one. But if I were just getting started again, it's a little more difficult. I would just average in. Dollar cost averaging is my best friend because I don't know if it's going to keep going up, keep going down. Averaging in over time has always been a wonderful strategy for me. And what that means is I just put a fixed dollar amount in each month. I don't put a lump sum. I average month after month until I reach my target position size. So something else, this kind of goes without saying, but I have learned this. Boy, I have learned this over time. For me, at least, because my strategy is buy and hold forever, for me, it's always quality over value. Let's say Clorox is never on sale again. Let's say it's always really expensive. I would still rather buy Clorox than something that is of value that I don't like as much. For me, because I'm buy and hold forever, because I will be using dividends to pay my bills, I need to rely on these companies. I want companies that are going to stand the test of time. I want companies that are going to treat me well as a shareholder. I'd always rather have quality than a deep value. That said, if I can get both, at once, quality and value, that's always a great thing too. And I've done some videos about that, about finding deep value. I will share in the description below one of those videos. You'll get a kick out of that one where I think there's some quality and value to it. It's a smaller position in my portfolio, but it shows how it is possible, at least, to find both. So the last point, and I've already mentioned this, is it really depends on one's strategy. My strategy is 50 plus years. I'm actually thinking now 100 plus years time frame. Obviously, before then, I'm going to be tapping into dividends. I want to use dividends to achieve an early retirement for myself, but I want to be able to pass on to the future as well. But when I am thinking that long, it really frames the whole topic, and the whole topic then becomes, okay, is Clorox really that expensive right now? Should I wait for it to dip, or should I just keep buying in? 100 years from now, is someone going to care if I bought it at 113 or 148? Probably not. And so it really depends. Even 20 years from now, is it really going to matter? And so it kind of brings me back. This is why I always buy stocks. I'm always buying more dividend stocks every month. Regardless of the market, good market, bad market, I'm always buying in because my eyes are on quality, cash flow, the long term, and I have a focus on that quality. So, hey, thank you so much for that subscriber-influenced topic today. It wasn't the precise question that came about, but it was more this comment from a subscriber. And look, I'm not trying to put down this subscriber. This subscriber may have a very different philosophy than me, and there are many different philosophies that work in the world of investing. I'm just sharing the one that works for me personally. So one fun, exciting piece of news, everyone. We're going to be doing a meetup in San Francisco for our local PPCE and community members. Yes, I'm so excited. I will link in the description in the comments below if you want to sign up for that. I already have interest coming in from a few people, and we're going to pick a date and time that works well for everyone. So sign up for the mailing list for our local crew, and you will be able to join us. We're actually going to be doing this at the Starbucks Reserve in San Francisco. Just had to do that because I love Starbucks. I'm a Starbucks shareholder. I know a lot of folks are too out there in the PPCE and community. So we're going to have a lot of fun at that first meetup talking about dividend stocks, early financial freedom, being frugal, being smart with our finances. So that'll be awesome. Also, before I leave today, in terms of full disclosure, I own the stocks mentioned in today's video. I am long. I own stock in Johnson & Johnson, ticker J&J, PepsiCo, ticker symbol PEP, McDonald's, ticker symbol MCD, United Technologies, ticker symbol UTX, Clorox, ticker symbol CLX, and Starbucks, ticker symbol SBUX. I own all of those in my personal stock portfolio. Also, a friendly disclaimer, I am not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Hey, thanks for tuning in. I know a little bit of a shorter video today. I did that on purpose because I had a subscriber ask for that. If you enjoyed the video today, you want to reward me, you want to say thank you, please subscribe. It means the world to me. Comment, like, all of that. Comment section below is thriving. I am so grateful for each and every one of you. You guys are the best. I love you guys. And again, definitely not trying to put down the subscriber that made that comment. That subscriber very well may have had a very different philosophy than me. But the reason I'm quite frankly bringing it up is what the subscriber mentioned, again, resonates with the types of philosophies that I used to have in the past that have changed, that I believe have improved over time. And so I'm really just trying to share my personal evolution here today. And so before I leave, again, just sharing my investment journey here on YouTube for fun and entertainment. I will see you all in the next dividend investing video.